When buying dividend stocks, I like to buy in sectors that I know people need and is essential, so during a recession, they are very unlikely to go out of business. One such service we need is insurance. We need to insure our cars, our homes, and many of other possessions even during a recession. I'm going to go over many of the popular insurance companies in Canada that are publicly traded and determine which one is a good buy for dividends. First, as a disclaimer, I just want to say I'm not a financial advisor, so please do your own due diligence before investing. Just to compare every insurance company in Canada, it's going to be way too much clutter for you to see any meaningful comparison, so I took the liberty to eliminate some of them that I thought were not quite as good, and as a way to remove some of this clutter. Just to note, that doesn't mean I didn't take a look at them. I did, and I personally wouldn't rank them at the top, but if there is one you feel strongly about, please leave it in the comment section below and I'll take another look at it. Since we're focusing mainly on dividends, right off the bat, I want to eliminate Fairfax Financial and EL Financial because they don't have a long history of increasing their dividends, and their dividend yield is also very small, even though their stock performance is better when compared to the rest. Two more I want to eliminate is Power Corporation and Power Financial Corporation because of redundancy. Power Corporation owns 65.5% of Power Financial Corporation, which in turn owns 67.7% of Great-West Lifeco. They all have a very similar trend in performance, which is expected, but since we are looking mainly on insurance, I'll be focusing just on Great-West Lifeco. When we take a look at their stock performance, over the last 15 years, there's only been one that has done exceptionally well, and that's Intact Financial. Most of them have subpar performance. When we break it down, we can see this clearly in the annualized return. Intact Financial may be performing the best out of the group, but buying at these levels, you're paying a lot of premium for it. But as all the other ones pull back, they seem to be a much better bargain. If we can get them at a good price, we can get some amazing yields, but want to make sure they continue paying and growing their dividends going forward. When we compare their 27 PE ratios, Manulife Financial has an abnormally high PE ratio. That's because of a one-time charge in 2017 that caused them to lose a lot of profit, which has lowered their EPS by a lot. The same would apply when we take a look at their payout ratio. It will be abnormally high, but if we base it off their 2018 EPS, it will be much closer to around 40%. But overall, their payout ratio is around 40-50% range, which I like since they can invest some of that back into the company. But when you take a look at the forward yield, Intact Financial doesn't seem to be as attractive compared to the rest. It already has a 50% payout ratio and the yield is under 3%. But it's kind of expected since the stock has been performing so well, it's definitely not cheap. So for me personally, it definitely won't be a top pick. We need a big pullback for me to even get interested in it. But that doesn't mean I would sell if I'm already holding the stock. I will continue to hold it. Another one I'm not very interested in is Genworth MI Canada, because when you take a look at yearly revenue, it's been flatline. There's been no revenue growth. I want to see the business grow. At least with all the other guys, they've been able to grow their business. Next, when you take a look at their yearly profits, the growth is not amazing, but they've all been able to grow that slowly. But you'll notice a big drop in Manulife Financial's profits in 2008, but they've been able to recover most of that since then. But when you take a look at the stock price, it hasn't quite recovered back to the same levels yet, and it's still on a lower range. On top of that, Manulife cut their dividends back in 2009, but every other one hasn't cut their dividends yet. Genworth may look like they cut their dividends as well based on the chart, but they haven't. You may notice a spike up in 2011 and 2014, but that's because of a special dividend they paid out, so for those 2 years there was a much higher dividend, but overall they've been increasing their dividends. When you take a look at their dividend growth, they've all been able to grow their dividends nicely over the years, between 5 to 10% a year, except for that one hiccup Manulife had in 2009. But when you take a closer look, you'll notice they've all been ramping up their dividend payout more in the recent several years. But back during the financial crisis in 2008, you'll notice little to no dividend growth. But now they're back on track and hopefully they will continue that trend going forward. Out of the 6 present, the 2 that are least interesting to me is Intact Financial because it's the most expensive out of the group and therefore has the lowest dividend yield. The second one is Genworth MI Canada because we just haven't been seeing any growth in their revenue. But out of the other 4, which one I consider a buy? I think they're all good, but I like Sun Life Financial and Industrial Alliance Insurance a little bit more than Manulife Financial and Great-West Lifeco because their stock has been performing better. But depending which one's on sale, I would consider buying that one. And as always, if you enjoyed the video, please like and share the video. It really helps out the channel. If you haven't subscribed yet, please make sure to smash the subscribe button. And thank you for watching. I'll see you guys in the next video.